Good good morning, everybody. Sorry for the small, for the small delay. We had some, some challenges. Um, can everybody hear me well and see me well? I'm sure everything is fine. So let's get started. Um, yes, hello, Ivis. Hello, Ilya, and hello, the rest of you that are online as well. Let's get started. Um, so first of all, just to speak briefly, you know, about the markets and what we're seeing in the markets. We have some very since this announcements the last week. We are still growing in the markets. The market is still trying to determine what will happen. If you remember, I spoke about last week about this issue of this and so, what the Federal Reserve have to do to increase the interest rates, to really increase the interest rates. It's more than just simply saying they're going to increase interest rates. That they have to take specific steps as to what will happen. And of course, as a result of that, many people don't know what will happen when they do take those first steps to increase interest rates. Um, and what they're doing now to do that is this reverse repo, which I explained briefly last week. Always, guys, try to whenever we speak in the class, in these sessions, always go over them again, research more, so you can have a fuller understanding. Because I am only able to speak of so much stuff, and of course I will also be doing these knowledge series from next week. But nevertheless, continue to study. And also, we of course have our Market Lab Facebook group now, and the Facebook page. So again, go there, check it out, and contribute. So okay, so anyway, as I was saying, we're now seeing these changes, in the markets. The market is seeing what will happen, and of course, crude oil continues. It's crude oil is still falling, and as you can see, I'm still I've still to yeah, I've yet to to get out of these crude oil trades. This crude oil and the pound Japanese yen. Of course, as long as crude oil stays low, the yen stays high. That's just the way it is. But nevertheless, it seems like we're starting to see some stabilization, with crude oil. So I'm just holding those and carrying those over until there's an opportunity to close them out with profits. Um, of course, and also, if you guys remember from last week, these two were nearly at minus 500. So they're gradually coming down. So all I'm doing now is just watching them and carrying them day by day until the time that I'm able to come out of them with a profit. And also, so at the moment, what I'm doing, I'm just taking small profits in gold and silver, um, and just gradually building up my accounts. So if we look at my activities, I took out some small amounts this morning, um, and then some smaller amounts yesterday as well. Um, yeah, I took out some small amounts because the key, what I would say is that um, sometimes you're in the market, and it's of course it's nice for you to get this the in cricket it's called getting hitting the six, meaning that you get the maximum points, because used to play a lot of sports, so I like to use sports examples. But sometimes it says you just need to grind out the results, um, when you're trading, especially when you see tight markets, like this. So take out the key is to try to make some money every day, make a little bit of money every day, constantly, constantly, constantly. So and just build up your account base. You're not always going to get the opportunity to make 1,000 euros, 500 euros, 2,000 euros, 3,000. Sometimes you're making 60 euros, 70 euros, 100 euros, maybe 120 euros. But these add up. If you're getting a few of these every day, it adds up, and also of course it builds up your um your um your balance, until the point, and each time your balance grows, you're now able to trade, with a higher amount. You're not able to trade with a high percentage. You're not able to to make more money, uh, per trade. So try to make some money every day, especially as we're now about to launch, to go live. Very, very important. Make some money every day. Every euro cent counts, because every euro cent is contributing towards your overall account balance, and that is what it's all about at the end of the day. It's all about your account balance, because that helps you to to put on bigger trades, and achieve bigger results. So while I wait for these to to start to move into profitable positions. Um, I have been making money, particularly on the silver and the gold. I'll come back to this Euro USD in a second, but I wanted to so with gold, for example, gold, you know, gold and silver, and of course work together, in alignment to with each other. They follow each other. So gold moves up and it comes down. Gold moves up and it comes down. If we look at the daily charts, um, it's much clearer here, because we can see that it starts from don't when you're drawing a trend line, don't use don't use the lower shadows, or the upper shadows, because that's extreme market situations. This is when the late people in the market get out of the market, or get into the markets. This is overbought and oversold. These shadows, the lower and upper and lower shadows. So if we wanted to draw some sort of trend line, sorry, it's not trend line. This the vertical and horizontal trend line. This would be for this market. This would be um, the support here, about there, and this would be the resistance. No, yeah, no, about here. So as you can see on the daily chart, if you look at the silver, the silver looks exactly like this, and as you can see, it's trading in this within this daily trend. um so, and of course, when you had this this went on very high volume. When you have high volumes like this, um this doesn't constitute a break in the overall trend. This is not a break of the trend, because as you can see, this was extremely high volume. When you see very high volume like this, above and beyond the average volume, then what you should expect to do in this type of case is of course look for an opportunity to fade this market, meaning to sell it uh, at this point, as you see the volume going higher. So you're selling you know um, up there, and of course, as you can see, within the next market, it fell, and then it tried to to go up again, but the markets rejected that higher price, and since then the market has more or less stayed within that pattern. So let us so look continue to look at let me remove this trend line in this. Okay, let's reset charts to default. All right, so let's deal with this issue of support and resistance, because I believe it's extremely important. Um, all right, so when you are in practical terms, um, we can see here that this is long term, you know, um, the weekly support and resistance. If I were to add this study, if I were to add the simple moving average over the long term, over a week, I wouldn't use a 14-day moving average. I'll use a 50-week moving average, so about a year. And what you can see, you can see, of course, the huge decline we've had in the markets. Again, I'll remind you, you must always start your trading. It doesn't matter what you're trading, whether you're trading forex, whether you're trading commodities, whether you're trading options, futures, whatever you're trading, even if you're trading bonds. This concept of support and resistance is extremely important, and it will move into what I'll speak about today in terms of risk management. Um, because it's essentially, um, support and resistance is about psychology. It's about market psychology. Um, because the market have memory. Remember, markets have memory. So you start with the long-term charts to essentially see where you are in the markets, um, and to put the whole market in context, and then so you see the whole market, and you then begin to to break down, you then begin to break it down into smaller time frames. It's like you see, it's like on Google Maps. You click on the map of Latvia. It's this huge, it's from a very high point, and then you then begin to magnify it and magnify it and magnify it lower and lower and lower, and that's what you're doing in terms of in terms of how you're trading, in terms of using time frames to your favor. So some people are trading want to trade the hourly chart, the hourly charts. Don't enter a trade and think, okay, this is the high of the market. Actually, this is not the high of the market. This is actually, the low of the markets. This is the intermediate term low of the market. So the market, can and will go up higher. So that's the first thing to to realize and understand about trading, in in this trading using long-term charts. When you start to come to lower and lower time frames, that then expands these parts. So for example, if we were to go on the dailies, yeah, then the dailies will highlight these parts here, these parts, and to show you that the last couple of weeks, the markets has been trading, has been in this range. As you can see, that shows you this here has been trading, in this range for the past few days. It's this since the 4th of December. It's been trading in this range from 1,000, 1,400 or so to 1,000, and 800. So this is the range, it's trading at. Okay, so can you use this to your favor? All right, so in terms of long term, um, if I wanted to draw, a trend line, I'll take this trend line away and do another one. Um, Reset chart to default. Okay, so if I was to do a weekly trend line, for the Euro USD, so we have a horizontal trend line. This would be my support, and this would be, um, hmm, my, well, yeah, here. This would be my re resistance. So this is looking at from the 21st of January. In terms of this year, this is what the markets, has done. Is being within, within the, this range. Um, okay, this is important because this then helps you to start to build up a view of what is likely to happen next year. So, we can see the market. If we go back to the market, you see the markets. Where are we now? We're now at, um, one 1,400. Yeah. So as you can see, this 1,400 was quite normal, in in the markets, and that actually at some point it was even lower in the markets. So in terms of looking at the trend line, you have this as your support. This is your long-term support, 1,600. Ignore, these extremes. You want to draw your support and resistance where you have the most congestion, where you have the prices touching, um the most. Don't draw it up here, and don't draw it down there. When you have really volatile markets, then I tend to put my supports around here. The reason for that is that the market has been here once, so the market can always come back there. Some people think I'm a bit extreme, for putting my stop loss here in very, very volatile markets. But it protects me. My first priority is to protect my capital. Of course, I wouldn't make as much money as I would if I was put it here, because I have to trade in smaller units, but nevertheless is extremely, extremely, extremely important. But in terms of drawing the trend line, in terms of looking at what will happen in the markets, what we're seeing here is that this market, for this year, has been trading in this range, trading this range. And what this is telling me is that next year, we should see this market begin to go higher. We should see this market begin to go higher. Um, let me add the Williams percentage R to this percentage range. So 50. Okay, so yeah, so the Williams percentage range is telling me that that of course we hit the bottom in the market here. At this point, this was on the 24th of November, and since then this market has been pushing up. Of course, we had some setbacks in the last week in terms of what was done with the dollar, but nevertheless it's important to realize that against the euro, despite the money printing that we're seeing, despite that happening, the dollar is weakening. um, you know, and I'm convinced that even with this interest rate increase, and all of the recent strength we've seen in the dollar is weakening. What we've seen all the way up to now has represented this issue with Greece, with this issue in terms of the eurozone. But I still believe, and I'm confident that going into next year, rather than that than the euros, we're actually going to see more weakness in the dollar, especially when the dollar breaks past this 1.1403 here. So this is the long time frame, because one of the problems with technical analysis is that you're looking at tech analysis. It's telling you what happened in the past, and sometimes it has limited value in terms of predicting what happened in the future. So what you need to do, of course, um, this is important, but you also need to understand what is behind um, these charts. And what you're seeing is the story of Greece. This is the story of Greece, all the way down here, and the so-called strength in the U.S. economy. But we see that there is no strength in the U.S. Economy right now. Demand is very, very, very low, and as the dollar stays strong, then that demand will continue to fall. So what they'll begin to do is next year, the U.S. government and the Federal Reserve will begin to weaken the dollar gradually and gradually and gradually. And of course, the euro will also become stronger and stronger because of the low interest rates. You now have more international borrowers borrowing borrowing in euros, to invest in other high yielding currencies. So all of this will create more demand for the euro currency, pushing the price higher, and also less demand for the dollar, pushing that lower as well. And especially when we're now bringing into the mix higher oil prices next year, which will actually force the yen even lower, and also force the dollar lower as well. That is the, in terms of the, your long term framework. That's how this helps you. If you're using the Williams percentage R, percentage range, for this, as you're seeing, this is a nice gradual, increase. And if you want to catch a growing trend, a long-term trend, then this helps you. When you see the Williams percentage R at extreme levels, past minus 20 here, then you know that the market is already overvalued and overbought. And of course, also when you see it below, below 80 here, below minus 80, then again, you know that it's oversold and it's due, for a lift. And that's what we saw. And again, remember, we spoke that the markets have memory. So remember, the last time the market was here, you know was this low, which was in 10th of March, 10th to the 11th of March. I remember that day. As you can see from here, the markets pushed up above that, and again it hit there again, and it pushed up above that, showing you that, that the market understands that. So this now becomes, a long-term low, long-term low. And the same goes for here. This with the market, which is April, May the 16th and May the 17th, to 25th. And as you can see, this resistance points, the market continues to touches it many times, but it falls. It falls, down against it, showing you, that has become long-term resistance. So when this market is to break this point, but when it breaks this point, um, and stays, this is not a break of the long-term resistance, because it didn't close, the week didn't close above that. And anyway, many people ask me this question: when do you know that the market has actually broken resistance, the re- resistance, um, point? For me, it has to not only close. Um, for me, if you're going on an uptrend, a real uptrend, the first candle will close above this, and then the second candle will also close above this on rising volume. So let's add volume to this. Of course, this is tick volume, but nevertheless. So as on rising volume, and then you when you see those, those two together, then you now understand that actually, yes, you now have a true break, and this points will now become the new supports, while the markets, will climb higher than that. So essentially, how you use your this these support, support and resistance. I also, use this for risk management, and I'll explain what I mean. Of course, we're using the 1 week, but in terms of looking ahead, to next year, what will happen next year, you have to use this as your theme whenever you're trading next year. Remember that, that we are, remember in this number, 1396, because that is resistance. When it starts to go over, over that point, you're now looking for, that, the market has broken that, that uh, resistance point, and is moving higher. So that's what I am waiting for, and I believe that this will be, the story, for next year, as to how the euros, the euro rose, massively against the dollar. It's so for me it to be an up and at the complete opposite of what we've seen this year, in that the euro has fallen, largely all year against the euros against the dollar. But next year we'll see that change, whereby the dollar falls against the euro. The same thing also goes for for crude oil. And then okay, okay, how do I use this in terms of risk management? Of course, I can just have my, the basic step of risk management is that you have your minimum supports and your minimum resist your support and your resistance here. And then what you then have next, you have the markets. You now need to start to look at how you can manage your risks. So more enough, the basic one is of course your 1% of capital. Don't go if you have big nice trends. Don't go more than 1%. If you see especially in the shorter term charts, say the daily charts, you see that the market is trading within a range, and it looks like that range will continue, and you want to make some money, then you can increase to 2% with very 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 tight stop loss. And in those markets you just sitting down at your desk, you're trying and you're trading. It hits keep your take profit tight, keep your stop loss tight, keep both of them very 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 very, very tight, and you can just make 40-50 pips regularly. And that's fine. But when you are looking at big trending markets, whereby the market will move 100 pips, 150 pips, 200 pips, um, you know or more than that, then you're now start then you now need to also keep your stops wider, and also allow your profits to run, but at the same time keep it at your risk at only 1% of your capital. That's the first part of risk management. The second part of risk management, okay, that as good as that basic framework is, it is essentially quite limited. What do I mean by it's quite limited? It's limited because it's very 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 static, and of course, meaning that it stays in one place. The risk management doesn't really move. It's not flexible, and of course the trailing stop takes that into account, and goes some way into taking that into consideration. But the problem with the trailing stop is that you don't always have huge huge moves in the market, um, that the trailing stop will really be useful. Meaning, so imagine, so you put your trailing stop to 100. Okay, the market can go up to 100, and can also drop by by maybe 70. So it doesn't really hit your trailing stops, but it's not enough to lock in some profits, because the trailing stops is that the problem with it is that it doesn't help you to lock in to lock in profits, if you put it too tight, then when the market retraces, it can take you out. But when the market is but if you put it too wide, then it is not so useful. So what we're now speaking about, in terms of dynamic risk management, is looking at the market, is looking at the market from a different perspective, is looking at the market from the perspective of money, um, as a forex dealer. A forex dealer, that buys and sells money, a market maker. If you're trading stocks, so how is a market maker, looking at this market right now? A market maker, as this is falling, they are buying. And as this is rising, they are selling. So the dynamics is slightly different from how many people trade. In that, as the market is falling, they are selling, and as the market is rising, they're buying. But for dealers, money market and money and market makers, as the market is falling, they are selling, and as the market is rising, uh, so as the market is falling, they're buying. As the market is rising, they are selling. What does this mean in terms of our idea of risk management? It simply means that as the market is falling, they must always be aware that the risk, that each time it falls, the risk profile changes, meaning that as it falls, then there's a greater percentage um, of it rising. So as it's falling, the percentage of it rising, is more increase, increases. So imagine let's look at the daily charts, for example, to help us uh, see this more. As this market is rising, then the risks. Um, okay, so you're buying in this market. You're buying in this rising market. Um, so your stop loss is here. Yeah. So the market is rising. The market is rising. The market is rising. But your risk is also rising. The risk of the market going lower is rising. I know this is a fairly new concept, for you guys, but bear with me so you see what I mean. So think of these as percentages. So each part represents the percentage of a fall in the market. So at this point, it's almost 100% unlikely, or maybe 90% unlikely that the market will fall to where my stop loss currently is in the market. Yeah. So, but as you go, it's now 10% risk of it falling, 20% of it falling, 30%, 40%, 50%, 60%, 70%, 80%, 90%, and of course 100%, and then it drops. Yeah. So what you have to be doing, you always have to um bear that in mind. So that actually when you start to go above this point, um in the markets, your risk profile actually changes. It turns around in the opposite direction. So now the risks of the market falling, is now increased. So that you now need to start to think of either, of course, on O1 that doesn't really allow us not to do that, but on other platforms you can actually begin to um, reduce your exposure um, in the market as this begins to rise, and or the best thing you can do is essentially don't wait for the market to reach this point. When you get to about here, um, which is the last the previous highest point. So imagine you are looking at this market at on the second of December. Yeah. and the markets you're in, you think this is the hammer, this is the low point in the markets, hit support again, and it's coming back up. So you're in the market. Um, it's rising, it's rising, it's rising. You're here. You don't see all of these. You only see this. This candle is rising, rising. At this point, I will be looking. I'll be putting my my take profit here to to get out of the market. We know this. The previous high. These previous points where you had a the last time you had a a change in trend in the markets. So that is where I will be putting my take profits. Um, in a simple platform, like Owanda. Of course, if I'm using a more complex platform that allows me to do more and has more functionality, then I can now begin to play around and develop some other stuff. But in a simple platform like this, where you just have simple buys and sells, you want to take profit here. Because what happens in the markets, for many people is that they wait too long. They want to time the market perfectly, and of course, that means that that they lose money. Um, because they're in the market when the market turns, and then they, they start to sell. So essentially, so I am taking my profit about here, and for me, that's enough. And of course, as you can see, the market keeps going higher, and then again it starts to fall. It tries to get again to go higher, but and then it falls because of course fundamental news and various other um, interesting factors in the global market. So that's essentially this is essentially called is dynamic risk management. Is being is we're going to begin to develop this this idea over the next coming coming weeks, especially going into January when we go on the live accounts. Understanding that for each percentage that the market moves, the risk changes, the risk profile changes completely, um, because the market changes around that. Um, the market Remember, the market makers are selling in this market. As it's going higher, they're selling here, and here they're buying. So as the profit is going the profit is going higher, so they're selling into the market. And so within each trend, uh, within each strong trend, there's a seeds of that trend's fall within this trend. So of course it looks like it's the big strong trend there, but they're selling in this trend, but it's not apparent because it's simply closed above this candle. It's simply closed above this. It doesn't mean that there are no sellers in the markets. It is being sold, but it's being sold into strength. So it's not apparent based on this. But as you now see, but the market, it then comes a point whereby the sellers start to overpower the buyers, and then at this point it's already too late. Of course, at this time you have the market also moves up higher because everybody thought that this is the retracement and that it would go higher, and then it did go higher, and then it's more or less stayed stable since, above that point, because we are in rising euro, in the season of the euro rising against um, the dollar. So there's good fundamental strength underneath this market. So that's why it's rising, and that's why normally I would expect to to see this retrace all the way back here, but it hasn't done so. It's actually built up. It's very very unusual in the market to see a big strong um, candle like this without the market on the daily charts, without the market pushing it back lower, which tells me that if we go back here, which tells me that the market makers, the dealers, the currency dealers, are actually now, um, um, you know, they're buying here euros, and they're now selling here, and there's strong buyers in this market. And as you can see, and it's the buyers who have now made this 107.94 the new short-term support, rather than maybe somewhere 106.644. So this tells me that there's underlying strength. The buyers are holding this market up and beginning to push this this market higher. Um, so if for those of you who are looking for for a market, a strong markets in which you can have a long-term trend, to make money next year, I'll definitely be recommending the buying the euro against the US dollar, because it's a rising market, and it's hit the bottom and is now beginning to to move up. The fundamentals the fundamentals are there. um, the the conditions are there, and also you can also see that the technicals factors are also there. So this trade, going into next year, ticks all of my my boxes. um, there are two. You can either, of course, this is not for for this class, or, for this webinar, but you can also, there are other ways in which you can actually take advantage of this, of the Euro USD, uh, coming, as we move into next year. One of the ways which you can do is also buy um, euro um, euro dollar options. You can do that. You can also buy this is a currency options, and you can also buy buy it on the futures markets. The euro Buy the euro against the US dollar. Um, Rising against the US dollar. Say you can buy the March contracts. I'll speak about this when we start to look at futures. You can buy the March contracts against the euro March contract against the US dollar, over the next 3 months. And again, you can also buy you use currency options as well, to do the same, and say that if the the euro dollar hits, say, 1000 1.12200, 1.1200, yes, then it brings you in here, and then so you now have from 1.0929 you buy at this point, and you then sell at 1200, giving you a large profit. That's if you're trading this with options. Of course, the reason why options is good, if you're doing that, is that you bypass all of these things, all of these short-term waves in the markets, and you just bet and speculate simply on the price, on the price in 3 months time. Of course, with a smaller amount of money called options premium. Um, and of course, if you're in terms of looking at the stock indexes, um, another way you can also take advantage of that, um, is through is through the U.S. Stock stock markets. For example, if the stock markets, when the dollar is weak, you now see lots more strength in the stock market, especially when interest rates are low. And then, but when the euro becomes stronger, you now see the euro stocks start to become weaker. For example, the German DAX, and including also the London Stock Exchange as well. So you now begin to see, as the currency appreciates and grows against the dollar, you now see that in the stock markets, local stock market in that country, or in those countries, the the value of the stocks actually starts to decrease, because they are not as competitive on the global markets. Um, so that's essentially the various ways that you can actually take advantage of this trend. So what I will do is, I'm going to record a video next week, um, um, or even later this week, that will give you an idea, really speak more about this concept of support and resistance, the real psychology behind it, so that you can all understand it, and also understand how it works, what you're looking for. When do you know you've had a break in support? When do you know you've had a break in resistance? How to measure that, and so on and so forth. And then so that will help you. Uh, you know that will help you, because it's important that you put the market in context. A break in support and resistance, you can only define that correctly when you put the market in context. Most people get whipsawed, meaning that that they think this market is going to go higher, and they buy to go higher, and then it falls and cuts them off, and then falls even lower. They have that because they're not seeing this market in context. If you put the market in context, you will see here, that at this point, this market was already at the very, 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 very top level of the resistance point. So it broke, and it closed, but you can see that there's those upper shadow there. It wasn't breaking, and you can see that the volume was beginning to fall. Volume had began to drop, and also the Williams percentage had begun to fall as well. The Williams percentage was pointing at at nearly, not quite, but almost at a overbought level as well. So with all of these, putting this market in context, this market is a market that that you should already been looking to sell. And of course, again, you also had these warning signs in terms of these small small candles. So essentially, technical analysis doesn't work by itself. First of all, you have to understand how TA works, place it within the context of the overall market conditions, which is conditions analysis, and also place it within the framework of the fundamental analysis as well of the market. And also get some insights from inter-market analysis. Look at the bond prices, look at the stock prices, look at the commodities prices, especially oil and gold and things like that, to give you a fuller framework of what's happening in the markets. Um, so yeah, so that's essentially it for today. Um, and then so let us watch and wait and see what will be happening in the market as we go into tomorrow and the weekend, and also of course into next year. But in terms of my what I see in the markets for next year, I see that we're going to have two things. We're going to have the euro rise against the dollar, and we're also going to have rises in the price of oil. The price of oil will begin to rise quite quickly, and I believe it will reach at least 70 to 80 dollars a barrel by this time next year, um, based on what I see in the markets. So that's where we are. So this allows us to begin to position ourselves into for what we're likely to see next year. Are there any more questions um, about these? Of course, these are things we'll begin to, as I said, we'll develop these concepts further in terms of risk management. I'll also be doing a lot on the knowledge series about risk management, about what to use, about dynamic hedging, about um, risk position dissection, how to see your markets and your trades, or your ideas to trade from another perspective, and that would then give you a fuller picture of the market. Because if you're seeing your markets from your angle, you see it as a good buy. It's a good buy, but always remember that you want to buy something and somebody wants to sell you something. Um, you think it's a very, very good product at this price. Someone is selling it to you because they have the totally opposite view, meaning that so you're buying the market going higher because you think it will rise. Somebody else is selling the market thinking it will fall. One person is wrong, while one person is right. And in fact, there's a third person who thinks that the market will just stay flat, and they're not buying and they're not selling. So it's important, that you want to go in the market and buy and go long. Also, try to see your trade from the perspective of the seller. What is the seller thinking about the market? What are the reasons why this market will fall? And then the person who's not even in the market, like here, when you have low volume, why is there low volume in the market? What are people seeing that's caused them not to enter into the market? So those two points of views, those two perspectives, um, should help to inform your decision. You need to not just see it from your perspective. It's a bullish market. I want to buy, but see it from their perspective. See what they're seeing. See what they're thinking. See what they are understanding. Um, from the market. The other two types of people in the market, and it's only when you're sure that you have that's when you can trade trades well and trade successfully. So for example, you're buying into this market. People are selling already because there are people who are thinking that it's too high. They're thinking that, look, volume is rising above average. The range is rising above average, and they're thinking, nah, this is a market, that they want to sell. But you're thinking, no, this is the strong market to buy. So again, which one is it? So that idea, that concept of seeing the market, position dissection, dissecting your what you see, dissecting your view, dissecting your position, and looking at it from different perspectives. It helps to make your trading richer and more successful, because you're seeing the market from three different perspectives. And when you can do that, then you now have a fuller perspective on that market, because then you can then go in and trade on this. But you can now understand that actually, um, I need to reduce my risk. I need to to find a way to come out, or even I will not take this trade because it doesn't meet certain risk return ratios. So all of these things, how helps you to decide. All these things helps you to plan your trades, to 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 work better, to be and to be more successful when you trade on the market. So that's essentially essentially what all we have time for today. And then next week, on this week Thursday, we'll look again at the markets. And then so that is, yeah, Christmas Eve. And then so, yeah, so let us keep on going. um, I'm waiting for this Euro USD to is coming is rising, and so I'm just got my eyes in it. And I'm just carrying these two trades, the Brent crude and the pound dollar. Again, as the dollar gets weaker, which it will, going to January, then I'll also be able to close these trades down, with profits. So we keep going. So have a very very good evening, a very good day. Sorry, and then let us speak again on Thursday. So good day.